All right, bring up my little chat box so I can see you guys. There you go. Nobody's chatting yet, so that's great. Well, not really. I prefer it when people chat. There. Okay, hopefully you can see my Thinkorswim screen. Hello, Mick. All right, so where were we? We have been trading the Russell this morning, and it's, well, this set is doing okay, but before I lost some money, so we're down 880 for the day. It's kind of in a no man's land right now. My average entry is right about 330, and I've only got 4 positions here. And I should have gotten all out when it went down here, but I missed it because I was busy setting up the webinar. So that would have been, I could have exited here with a profit, unfortunately. My cost of doing this webinar is really extreme sometimes. Although last week it was way down, and we actually made some money, so it worked out. I think actually what I want to do is show you guys. I'm just, as far as I saw, and I just did the news, as far as I can tell, there's nothing big going on. We had a little pop out of Europe on the close. They closed strongly, but not so strongly that I think that we should be higher. Of course, everybody's anticipating the Fed tomorrow doing something, being easier or something like that. But what we're doing here is my average entry price. Well, wait a minute, that can't be right. Okay, you have to ignore that at this point. Bottom line is if you're down $1,200, that means I need $1,200 to get even, which means I need a 3-point drop here. So I need one, so my average entry is 132-ish. So I want to be very careful here if I'm going to add, and I want to add as close to 136 as I can, because it seems to have gone up there. And if I know if I add 4 more at 136 and my previous average is 132, that's going to bring my average up, of course, to 134. And if I get to 134, it means I can stop half out at 134. So I would love to buy some more right about here. All right, that would be my goal right now with the Russell. I'm not going to, I guess I could put 1 in. All right, let's put 1 in. That'll just at least give me a little a chime if it hits it. So while I'm doing some other stuff, so I'm not going to stand here and stare at it with you guys, but that's where we are. Now, what's my premise here for being short? Well, first of all, I think that a 2% move on the Russell for the day is too much, okay? And if it's 2% is too much, then that means I'm going to expect at least a 0.4%. That's a weak retrace, takes you back to 1.6 from 2%, right? So 1.6 turns out to be a little bit below 135, so I expect that to be my retrace point. And a stronger retrace would take us down another 0.4%, so that'll take us down to, oh God, how do I calculate that? Let's say probably 4 points more, so figure 131. So a strong retrace would take us to 131, a weak retrace takes us to 135, 1135. So that's what we're looking for off of this run. This run is ridiculous. So to go from 120 to 135 in one shot, which is that's a big move in the Russell, and that's going to be and really your run came from here and never slowed down. You know, it has a little mild retrace here, but on the whole, this has been a staggering run, and I would call it off that 11,000 line there. And so you go up from 11 to 1135. That's obviously over 3% for that move. So again, you expect it to pull back to the 2.5% line. And what's the 2.5% line? Well, we'll take 1100. You just want to keep confirming by doing the math. So it's like 1100 times 1.03. Well, sorry, 1.025. So 1127. Oh, and there it is, 1127 is right here. 1127.50, that's your 2.5% line. Okay, so you can see how that acted. It came up, blasted through the 2.5% line, tested it for support, so you know it was strong here, and it went up another, probably that's another 1.25% from there. Let's see what 1135 is. So it's going to be 35 divided by 1100, 3.18%. All right, so that's 2.5%, then another, well, it's what we just said anyway. So that's 2.5%, and obviously another 1.5%, 1.6% gets you up to there. All right, so here's your 2.5. Now, what this means is probably we're going higher, frankly. I mean, when you see what you have is a decelerating move. You have a 2.5% move, where it pulls back a little bit at 1127. You have a little bit of a pullback at 1127, but not much. You generally ran straight up to it, consolidated, major move up, consolidate, fake down, move up, completes the move to 1127. Now we go through with some follow-through. And how much is a follow-through? It's half of the original gain. And if you pull back here, if you never get back to that 1127 line, if you never get a strong retrace, wait, I'm sorry, what we say strong retrace was 1131, right? So if you never get back to one, and see how it is, here's how 1131 was a stop over here. If you don't get back to this 1131 line and fail it, you're still consolidating for the next move up. It's just like this. Consolidate, pull back a little bit, and then zoom up. So here we're consolidating, pull back a little bit, possibly another zoom up, but not today. And by the way, that next zoom up, though, should be half of this gain. So you're only looking for another maybe 1% after that. That's how these runs exhaust themselves. They go and they start, it's like a bouncing ball. It goes half and half and half and half. Each bounce gets smaller until you hit the top, and then you consolidate. If you consolidate at the top, you can maybe get some energy again. Or if you consolidate at the top, you might fall at some point. All right, so where are we now? 34.6. So that's boring. We'll move on. And Mick says, new CLS CEO, wait, the CEO of Cliffs who just came on says, I'm not going to answer your question. You have 4 targets. I love that. He says to everyone, I hope you all read that. That's funny. I would do that. See, that's why I don't know. He got away with it. If I was the CEO, that's exactly what I would do. I'd be like, screw you, you idiot. People start asking you questions about your company. They have no idea what you do or how it works, and they ask the most inane questions. You know, most of the CEOs just ignore it and sort of do their little spin thing, but sometimes you do want to smack these people. And I'm sure the CEO of Cliffs doesn't care if he ever gets invited back on TV, since they probably haven't invited him back on TV in like 20 years. All right. Where are we? Okay, first of all, questions. If anyone has them, now's a great time to answer. But I have a lesson plan today. This is very exciting. I hardly ever have any kind of plan. We talked about some really important stuff yesterday, so let's go over it. Because I can kind of illustrate some of the points that we were making yesterday and today. So we knew we were having a strong week. We ran into what I said was going to be bad data. We had some bad data early on in the week, and we know that, but we still have the Fed coming, but it doesn't seem to matter much. We're still plowing ahead. And we're plowing ahead. We're going up to this month. We're heading up here. We're probably almost there now on the New York Stock Exchange. The Russell, there's that 1140 line. Here's that resistance that we're hitting. It's a falling 50-day moving average. It's a 1129. Then we have a lot of resistance in this zone. It comes fast. 1129, 1140, and 1146, all giving you resistance. If the Russell does get up here and pop, what's going to happen? Again, I always want you guys to think about, like, don't look at a chart and look at what happened in the past. Think about what will happen in the future. And so every day, the Russell is above this 50-day moving average, which is 1130. So let's say 1130. Every day you're above 1130 on the Russell. What happens? You're pulling the 50-day moving average up. And it's not that down to begin with. It's kind of not too far off flat here. Doesn't have a very big down curve to it. So every day above, you're pulling this up. And what happens here? You're also pulling, if you're below, though, if you're below 1145, you're pulling the 200-day moving average down. And then you get what we call, in TA world, it's called a triangle squeezy thingy. Let's see if we can find one. Kind of this. You sort of make this sort of pattern that resolves itself. It's hard to tell on day chart, but it resolves itself into like a little triangle. And you go up and down, and it's like a little bouncy ball. And then eventually you're going to break out one way or the other out of your little range that you're stuck in. But you ping pong back and forth between these support and resistance lines. And sometimes it consolidates and you do it for quite a while, like this thing over here. See, consolidate, 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 and it doesn't have to break down, even though it looks like it's going to break down, because it actually had a triangle squeezy thing heading into a new support that came up to meet it, and it popped it up. And then it went back down and had to take another. In order to get through this, it had to go up again to get some strength, and then finally made it back through. So in this case, though, this is rare, but you can predict a triangle squeezy thingy. So if the Russell's above, and it's above right this minute, and it holds 1130, and it fails to get above 1146, even if it lasts for like a few days, you're going to get this little zigzaggy pattern here. And what's going to happen, though? The 50-day rises, the 200-day falls, and what you get is the opposite of a death cross. When the 50-day falls below the 200-day moving average, that's a death cross, and that's a bad sign. And we talked about that when it happened. We said this was a bad sign on the Russell. And in fact, we talked about how you can predict that you would have a death cross. Because I said, if the Russell falls below here, you're going to drag that 50-day below, and boom, and it did, and then it caused an incredibly bad sign, and we made a fortune on that on the short-term portfolio. But now, we've had our fun, we had the pullback we wanted to have, and now we are looking at a life cross, because if the Russell can make it over this point, it's over it right now today. If the Russell can hold that point and get over it, it's going to bring that 50-day moving average up. And even if it does go over the 200, it's still the 50-day moves 4 times faster than the 200. Therefore, it's going to rise 4 times faster, and it's still going to make that cross back over. So anything over 1130 on the Russell now is extremely bullish every day. And in member chat, we were just talking about those lines. Let's see. Where are my Russell charts that we were talking about? So we had this conversation on the Russell where we were talking about with the support, and I said you've got to look at those long-term. This is a 10-year. Wait, is it the wrong one? Why am I confusing myself? Oh yeah, I said you've got to look at this 10-year chart of the Russell. Here on the short-term chart, 1130 is significant. Okay, that's what I was talking about. I wasn't at the time looking at the 50-day moving average, but it turns out 1130 is a 50-day moving average. But even just using a 5% rule, this is how we're able to tell what the without seeing the moving average. So we knew 1130 was going to be significant. So here we zoomed up to 1130 something already today. Then I talked about now you have to back out though. Here's the 10-year chart of the Russell. So these are monthly candles. And it's funny because it makes you realize how insignificant, that was the context I was talking about. See a dip here? Here's support along the 1100 line. Good support, good support, good support, fail. But the fail isn't enough to make a monthly candle. So you're still holding the 1100 line. All that is, see that's what we call a spike. When you have a spike like that, we don't pay attention to it when we're doing our charts. Spikes are irrelevant. You have spikes all the time, up spikes, down spikes. We throw those out. They don't count. Here's a bunch of spikes. You don't count these spikes down. They don't matter. You don't count the spikes up. They don't matter either. It's not enough. It's not a significant move. Even though, now see, these are monthly candles. So a spike, what this little spike in a monthly candle, all the way down, all the way back. But because it took place inside the month, it just, the body of the candle is still over here, above the 1100 line. So right there, we held the 1100 line in the month of September. We held the 1100 line in September. See there's the end of September right there, the 3rd. This is probably October 1st right here. Here's September 30th. And as soon as we're back above in October, that means this candle formed on a monthly basis a strong, strong support. So there's good indication here that the Russell will continue to go higher, will form that life cross of the 50-day moving average, will get pulled over the 200-day moving average, give us a huge bullish signal, and power higher and break to new highs. Big move. So this is a very big, exciting thing that could be happening. Now, if that's going to happen, if the small caps are going to do that, that means the entire market could do that. Get back to a chart though and see what we're doing. So that means it's probably not the best time to be taking heavy bullish bets, heavy bearish bets. Sorry. I just think today went a little too far, too fast, and I'm looking for a mild pullback. But that mild pullback, if my average is 11, I think I said my average is 1132. Is that right? So if my average is 1132 and we get a pullback to 1130, I make $800 instead of losing $800. That's what I'm kind of looking for. But I'm not looking for any great shakes, okay? We just covered a spread using TZA in the short-term portfolio. We just added that, but it's not a very aggressive spread. In other words, we did a shoot, no idea what that is. Okay. I have most calls turned off on this line, but I won't read for whatever it is. All right, so where were we? All right, so this is all yesterday. I know I had another thing I wanted to talk about. No, I'm sorry, that's today. Yesterday, back to our lesson plan. There we go, somebody got it. All right. I know I said something important yesterday I wanted to talk about, but give me a second. And please, if you have questions, ask them. That's how we move these discussions along. Hello. What was that one? Oh, we got out of the TNA. That's a shame. Wow, no, I'm sorry. That's a good thing we got out of TNA. See, that was yesterday. We had a bad signal. We had those TNA short calls in the short-term portfolio. And because we weren't getting, look, we're not getting the sharp sell-off, so I think we may as well buy back the TNA short calls, okay? That's good. All right, net 3, why push our luck? Okay, do you know how blown out we would have been by this thing if we had pushed our luck? Let's take a look. TNA November 67s. We had shorted them. We got out of them for 265. TNA. And now they're $5. That's them. Okay, so we saved ourselves 100% loss on those TNAs because we weren't greedy and we stuck to our plan. We didn't get the signal we expected and we get out of the trade. That's how you have to do it. You go in with a premise, but don't forget your premise. Because when your premise is blown, you have to get out of the trade. You don't just stick with it just because you thought something. That goes back to I was talking on microwave oven theory of investing. And it's like that. It's just that you kind of, like when you put a pizza in a microwave, right? Frozen pizza or something, and you just randomly hit like 2 minutes or something like that. Or maybe you hit 222 because you like to press the number pad. But you kind of watch it, and as you watch it, maybe you see it bubbling or something like that, and you change your mind and you press stop. Or some people press stop, but a lot of people just sort of like feel stuck with whatever time they put in. And that's what investing is like too. You put your money into an investment because you think something, and even if you get new information, you don't change your mind. And that's a very, very bad habit, very, very important to break. You have got to get into the habit of just, when you have new information, you need to get out of something. You need to be able to change your mind, change your stance. All right, so let's see. Jim says, I think we need to look at our SQQ 40-50 bull call spread for a possible adjustment. No, we do not, because we don't know when the SQQ is going to stop going up. And also, we are prepared to lose money. It is a hedge. And we were just talking about that. It's a hedge to protect the long-term portfolio. It is not supposed to make money. It's supposed to lose money if all is going well. And so far, all is going well for our long-term positions. So we will adjust it when we feel the NASDAQ is toppy and it's worth adjusting. But at the moment, it's a very, very small loss. We'll look at that in a few minutes. It's a very small loss, and it's exactly what we expected out of this position if we had a bullish move. What we took up was the aggressively short position of TNA because that would have squashed us. That would have cost us a lot of money. The SQQ is not going to cost us a lot of money, and we'll adjust it to April later, but not now. We only just had a one-day gain. Jal says, listen to you explain the going higher. Why wouldn't you go long? You look like you're short. Yeah, we'll go long. We'll be happy to go long when it hits. When it breaks levels that we think it will. Right now, I think we're going to get rejected at 136, and we did. And I expect to retest 131. Although technically it did when I wasn't paying attention, so maybe I need to rethink what I'm doing. But I think, see how you have this little motion here? All right, I think we're still overdone based on the fact that this guy's not climbing and this guy's not climbing. He's not making his 4075 that he needs to make. Based on that, and based on the fact that we gained 2% in a day, I want to see some more of a pullback here. All right, I don't know I will see it, and I could end up going bust on this thing, but I'll have to see. I only have 4 short, so frankly, even if it suddenly leaps to 140, I want to be even shorter. So I'm not too worried about it right now, because even if it goes to 140, now 140, I know exactly what it's going to cost me. If it goes to 140, I'm going to be down 4 times $400. right? So from 130, well, from 135, let's go 500 bucks. I'm going to be down $2,000 more at 140, but I will be happy to double down at that spot. All right, and that would bring my average from 1132 to let me see, it's 8. That's going to be 1136 will become my average, and then what I'd be looking for is a pullback to 1136, and I would get even and possibly, hopefully, do better on the way down. All right, so that's my long-term sort of play on this. This is a very, very aggressive play. It's called laddering. I ladder in, I ladder out of these positions. It's a very aggressive way to play. I certainly don't recommend it for anybody who's beginning because it's just so dangerous and you can get really whacked on this thing. And also, nobody who cares if they lose $2,000 should ever play like this either. I mean, for God's sake. You know, I think I explained that last week. It's like if I lose $2,000 on this trade, I'm going to choose to eat at Nobu 2 less times when I go to Las Vegas next week. You know, like basically I'm staying at the Nobu Hotel next week in Las Vegas, and I'm going to probably eat at Nobu maybe 5 times in a week. So maybe I'd eat there 3 times in a week instead if I lost some money. You know, so it's not like life-changing decisions I'm making here. Oh shit! Look at that. There's that pop. That's when we had that one sell down for 1136. And it just zoomed right up to it, which is really annoying. So that spiked up to 1136 and filled our position. So now I have another one short, but I'm not going to be happy if we go over 1136. I'm going to have to watch that more carefully. All right, anyway, back to this. So anyways, like I said, so it's very important that you know your risk tolerance because you can't play fast and loose like this is with the options if you don't have the risk tolerance to lose the money, because you're gonna be in the wrong mindset. You know, like I'm sitting here talking to you guys and be like, oh yeah, it's $1,000 down, $1,000 up, whatever. You know, you can't do that if you care whether or not you make a couple of $100 bucks. That's just crazy. All right, and you play a much more conservative game, and that conservative game means you would not. What you're saying, you would not be betting short right now. Conservatively, you should be looking for a time to go long. And actually, the conservative bet is to take a long off this 1132 line, where I'm short, unfortunately. But I'm short because I bet short on 1130. I thought I was doing okay, and I missed it and spiked up like that. That's how I ended up short. So I started at 1130, doubled down at 1134, ended up short about 1132. Okay, and then that line has been holding since then. All right, so that's been bad for me. A conservative play, you would have been either short here and gotten out before it broke back over, or you would have taken the long position here, or the long position over this line, or the long position over the 1115 line, or the long position 1100. You know, those are better support lines. And we were talking this morning, actually, I said below 1120, but with very tight stops, and here's why. Look what happens. Below, there's a little bit of money to be made here early in the morning, but then as soon as it broke over, that was the end of the short trade, and up it went. All right, so let's see. Do we like Coach, Mike is asking. Yeah, well, I like Coach in general, but they really were disappointing. We played them last year, and by playing them last year on and off, we finally decided that they weren't doing a very good job doing their turnaround. Their shoe line, I thought was going to be really good. I thought their shoe line was going to be successful. Doesn't work. I don't understand women. I thought they were great shoes. They looked cool. They were no more expensive than anybody else's ridiculous shoes that girls buy. But for some reason, they don't have a reputation for being a shoe store, and people don't go there to buy shoes. Didn't work. They might, you know, get it over time and get people to start looking at them that way. But they put a lot of money into that. It just did not do it for them. Also, a huge amount of their business is in China, especially a marginal profitable business, and China has cracked down severely on corporate gifts and corporate expenses and things like that, so it's hurting all the luxury brands to some extent. In this country, top 1% people are buying stuff like crazy, but it's still, in fact, there was a cool article in Bloomingdale's yesterday about this mall in, where was it? It's in Long Island, and people, you know, they have like basically butlers working, you know, the stores have butlers. They're all like super high-end stores, and people who go in there will drop like $100,000 on a shopping spree. You know, the people that rich go into this mall to buy stuff. It's all ultra luxury, everything about it. So, you know, those people, of course, they don't care what things cost, and they go in and buy whatever. But that's, you can't support a company. A big company can't be supported by that. You have to have larger scale sales. And not having the Asian market with Japan in deflation and China cutting back, that's not a good combination for a luxury brand. Let's see. Dan says, Facebook earnings, take advantage. I don't know. What do they have earnings coming up? Let me take a look. FB. $80. Shit, I wouldn't pay $80 for Facebook. They got a forward PE at that price of like 85. They earn about $1 a share. So their forward PE is 85. So I wouldn't touch it. They could, though, show a lot of growth. In fact, Facebook, to me, I don't think you can avoid the ads. So they got to be generating ad revenue. And it's got to work because people are still on Facebook. So I think they're going to show good growth. But whether I would buy that growth or whatever, I don't know. Apparently their earnings are tonight. Oh, what do you know? So let's take a quick look and see. So first of all, how would we analyze this? We're going to look first of all and see what Facebook does when they have earnings. Without getting all researchy, we'll just assume, since this is the end of October, that their last earnings were the end of July. Son of a... Their last earnings were the end of July, and those apparently did not go well. Okay, so they went down, but then they recovered. Their previous earnings to that were the end of April, and we can't see those, but apparently not so good because they went down into May. So generally, they've been selling off on earnings. They can't make people happy enough with what they're doing. They're up from 60, they went from 30 to 60, 100%. Then they go from 60 to 80 is another 30%. So they're having that slowing sort of pattern. So I would say I feel good about saying they're not going to get to 100. I probably won't get to 90, but they certainly won't get to 100. So now we want to take a look at what kind of options that would give us to play with. Let's see, Facebook. So now let's see what other people think about them getting to 100. I'm not going to play October, of course, because who the hell knows what's going to happen in October. But November, now nobody thinks they're going to 100, right? So that's apparently so obvious. Nobody thinks they're going to 90. That's interesting, though. Notice that if you're shorting Facebook, they're at 80. Okay, so if you go long, they peter out to $1 by 87.50. So less than a 10% move. So betting on a 10% move, it's $1 over here. If you want to bet on a 10% move over here down to 72, also $1. So essentially, nobody really thinks they're going to make a 10% move on earnings. I think they could go down 10%. So I think that kind of makes that short interesting. But would I play it? Nah. If I was, so the bottom line is, if I was going to play Facebook, I'd buy those puts. They're the 72 puts for $1, $4.05 actually. So for $1.05, I think that would be a fun way to play. And what's going to happen? They only have an 18 delta. So if Facebook goes up $5, these guys are going to lose. Well, let's take a look down here. Figure they'll. Oh, I'm sorry. These are the 72 puts. That was 72.50 puts. So I would take the 72.50s for 105. So $5 move down, that takes you to 77.50, 67.50. Sorry, and that's 38 cents. So you're risking losing 70 cents, right, on the downside. So if Facebook goes up $5, you're going to lose 70 cents. If Facebook goes down $5, then these will be worth what the 77.50s are worth, which is $2.50. So you can make 150% or lose 70%. It means your reward is twice as good as your risk. So I like a trade like that. That's fun. So if I'm going to play it, I would play a fun trade like that where I think it's going to go lower. I'm taking a trade where my reward is twice as much as my risk, And so let's say I put $1,000 into this thing, and that means I could lose 700, but if it goes well, I might make 1,500. So that would be the bet. All right. Let's see. But I wouldn't put that in the portfolio because I don't feel I don't have any kind of degree of certainty on that. I don't, you know, if I felt 50%, I have to feel better than 50% certain that Facebook's going to go down. I really don't. I think maybe just barely over 50%. I really don't know what they're going to do. If I felt 60, 70% certain, I would absolutely make that bet in one of our portfolios, but I don't. You know, I mean, look, there's thousands of stocks, and most of them I don't have a play for. Wayne says, I sold a 216 put on clip for 274 when it was just under 8. Now it jumps and the put value has not decreased. That's because the volatility has skyrocketed. The internal volatility, not the VIX, but the internal volatility of Cliff has skyrocketed. So at the moment, it's a stock that's capable of moving whatever per day. CLF. So it moved to $1.70 in one day. You're talking about a trade that's 400 days away, right? 2016s. So you've got a 440-day position on CLF, and it just moved 174 in one day. So what do you think the odds are it might move down $3 to $8? That's a 2-day move for Cliff at the moment. So that, you know, the internal volatility of Cliff has now spiked to a ridiculous level. That's why your thing's still high. All right. So obviously, frankly, you know, you say that, and what my attitude would be like, okay, let's sell some more then. Do you regret not selling more? I sure do. Where the heck is that? The 2016 put on Cliff. Which one? The $8 put? That's not 274. That's 210. Do you mean this one, $10 put? That's $3. Anyway, so you could still sell if you didn't play Cliff first. Well, this one's fantastic actually. Which one do I like better? That's toughy. If you sell this for 2, you net in for 6. If you sell the $8 put for 2, you net in for 6. If you sell the $10 put for 3, you net in at 7. I don't think I mind owning Cliffs at 7, so I love this play. Selling 2016 $10 puts for $3. You get, this is what I love, these kind of things, because you just found out that Cliffs is doing great. Everything I kept saying Cliff for ages. You just found out Cliffs is doing fantastically. Here's the 2017. You get $4 for those, or you get $3 for these. You get $3 for the 8s here, or 275 or 276, whatever. If you can sell those for 276. That means you're getting a net 525 entry, basically, on CLF. It's half price. All right, so I like that one. I like selling the 8s over here or the 10s over here because I have more faith. But frankly, all right, let's be realistic though. If I'm gonna take that, you're much better off with this one. So this is the best trade right here. If you want money, here's a magic money machine for rich people. Watch what happens. I'm gonna sell. I'm not gonna sell for 244. I'm gonna sell for 276. Dun, dun, dun. Okay. So 276. All right. So let's say 275. Now, how much money would I like? This will give me $2,750. Let's get $10,000. So let's sell 50 of those suckers, right? 50 of them is going to pay me, you know, something maybe like $12,000. Let's see. Oh, $13,750. I'm going to be handed. Here's how the Fed gives rich people money. I'm going to be handed $13,750 in cash. All right? And what am I being handed that money for? I'm promising to buy CLF for $5.25 net. So I keep my cash. Worst thing that happens is I get Cliffs put to me at $8. So in exchange for me promising to buy Cliffs for half, not even half price, it's $11.01 now. In exchange for me promising to buy CLF for $5.25, I'm going to be paid right this minute $13,750. Okay? And I'm going to, my obligation is 500 shares. It comes out to $26,250. So I'm being paid 1/2 of my obligation up front. For buying Cliff, I'm getting a credit of $13,750, and my margin effect is $3,200, $3,240. This is how rich people get richer. Because when the Fed is backstopping the economy, and you can do trades like this, and you can make a return of, what is that, 4 times margin on a trade. This is how rich people, when I say free money, and I talk about this a lot, how they hand out free money, this is what I mean. When you're in an environment where the central banks are propping up the markets and making sure that all these companies survive and all these stocks survive like this, you can make incredible returns, stunning returns. Now, obviously, you don't want to overdo something, but even, as I said, even if you say, I'm going to set aside $26,500 to buy clips, well, I'm going to get paid $13,750. I'm going to get paid 50% now, today. They're going to hand me 50% of my maximum commitment today. That's a 50% profit over the course of 2 years. The thing's going to be open for 2 years, but I'm getting a 50% profit for taking $26,000 and putting it aside. All right? My worst case scenario, I might own $26,000 worth of CLF. That's my worst case scenario. My best case scenario, I have $13,750. 50% of that. The margin is nothing, but I think even if you don't want to play with margin or anything like that, this is still stunning money. Even if you have an IRA account, that's stunning money. Even if they're hitting you for the full $26,000 in margin in an IRA, that is a stunning return on your money. It's a hell of a lot better than putting it in the bank. Now you don't do the whole portfolio, but at any given time, like in our long-term portfolio and our income portfolio, we're going to have 5 or 10 of these trades running at any given time. And usually they are 10 contracts each or something like that. But this is a small money stock, so it doesn't matter. It's still around that level. And if I have 5 trades running like this that obligate me to buy $100,000, $200,000, $150,000 worth of stock, but I get 13,000 times 5 trades, that's $65,000 in exchange for my promise to end up buying $100 and something thousand worth of stock. Why would I not take that? And of course, obviously, in a regular margin account, not portfolio, in a regular margin account, my margin is only going to be, if I end up owning the stock, my margin is only going to be $13,000. So my return on ordinary margin is 100%. My return on on portfolio margin, though, is 400% return on margin. That's why you see the top 1% going parabolic. Because when you have the money to be able to play like this, you can make incredible, stunning amounts of money. And that's what the Fed's been doing for the top 1% for the last 2 years. So, am I still bullish on CLF? Of course I am. It's ridiculously low. It's, as you know from me talking about it over and over and over again, it's ridiculously low when it's down around $10. It's just stupid. Let's see. Steve says, when selling puts against a stock in a buy right, okay, is it preferable to wait for the premium to run out or do the roll of the option pricing? Well, it depends. Unfortunately, there's no easy answer to that. Depends on the stock, depends on the price, depends on what you think the stock is going to do between now and then. Every quarter, at least, you should be evaluating. We do it like monthly with the long-term portfolio positions. Every quarter, you should be evaluating every single position and saying to yourself, gosh, what do I think is going to happen now? Is it still worth holding this position? Should I be adjusting it now? Are there opportunities to roll? There's no set time. We did a lot of rolling to 2017 the last couple of weeks because the VIX finally went up. The VIX hasn't been anywhere near the VIX hasn't been over 15 in so long, I almost forgot how long. But the VIX finally hit the 20s, or not the 20s, I'm sorry, hit the high teens. And the VIX in the high teens means that we get better prices for selling long-term options. So we take full advantage and we sell as much premium as we can when the VIX is high. And in fact, I'll show you something stunning because we did that in the income portfolio. Where's my income portfolio? We did that in the income portfolio. The income portfolio a week ago was at like 2%. And let's see where it is now. Because we did a lot of that. We did a lot of rolling and selling the income portfolio because we took advantage of the dip. And now it's 16%. That son of a bitch thing went up 12% in a week. All right, so, you know, we took advantage of the dip and we added. And why did we do that, though? Because we were so cash. We had, we were lower than this. We were close to like only $100,000 in margin was being used on this account. That's a $500,000 base account, and that means we had $1 million in margin. We were using like 10% of our margin in this account. Now we're using 17% of our margin in this account. This buying power is wrong because it doesn't count for any margin. So we were using 17%, but now we're using 17%, so we're still only using 20%, less than 20% of our buying power, but there's a real powerful leverage in this portfolio. I complained about it on the way down because I said, gosh, we lost a lot of money on this stupid thing. But on the way back up, it's great because we did all that. But it's all situationally dependent. We did it with some things. We didn't do it with others. We did it when we had a good deal, when there was a good option to roll to, when we liked the stock enough to put a little more cash into it. You've got to make all those decisions all over again from scratch. There's no automatic anything. All right? There's no time. There's no special time. There's no special place. None of that stuff. You've got to make these decisions every month and look for, and always look for a better opportunity. Always look for how you can improve your position. All right? So I hope that helps. Jim says, I know we have Baba. Oh, yes, indirectly we are. Any interest in Baba? No. I trust Baba as much as I trust Baidu. I really don't trust them. But what I do trust, though, is that push or shove, Yahoo owns a lot of it. And so whether it goes up or down 20%, I can give two craps. I just know that Yahoo owns a very big chunk of Baba, and it's not being reflected properly in Yahoo's price. So, and also with the amount of gains we get in Yahoo, I don't even know why you'd even have any interest. If you want to be bullish on Baba, why would you not play Yahoo? It's not in the income portfolio, it's in the short-term portfolio, isn't it? And even that I consider risky. If it's in the short-term portfolio, it's because I'm not comfortable with it. If I was comfortable with it, it'd be in the long-term portfolio. If it's in the short-term portfolio, it means I want to watch it. But even so, with Yahoo, what do? We have the April 32.39, very conservative, bull call spread. They're at 45 now. And we sold the 37 puts because that's where I put my foot down and said there's no way they're going below 37. And, of course, everybody was freaking out when they were below 37, but worked out in the end. Now, we paid 24 minus 22-ish. So we paid about $2,000, $3,000 for this spread. Now the spread is showing us $6,000. So the spread's up 100%. But it's going to be up a hell of a lot more than that when it's done because this spread off of our original $2,000, off our original $2,000, $3,000 that we paid, we have 30 times 7, it's $21,000. So even now, from this spread right now, if you can get in net 6,000, this is a $21,000 spread. Why would you buy Alibaba when you can spend $6,000 on Yahoo and get $21,000 back on the exact same premise, except if Alibaba drops 20%, you probably won't lose all your money on Yahoo. It's like a buffered way to play, and it's no joke. 6,000, 21 is 15,000, 250% return on the 6,000 if Yahoo holds $39. So if Yahoo doesn't drop more than 10%, if Yahoo doesn't drop 15% by April, this thing goes from $6,000 to $21,000. What could be better than that? Why would I want to play Alibaba when that's such an obvious connection? You don't get many chances to do that. You know, if every dollar you would put into Yahoo, I would put in 5 into this one. Let's see. Can't get excited about Facebook. Yeah, I really would rather play the downside on Facebook. Mick says Gartner's premise was LMT getting their fusion reactor commercially operational. Did I miss something? I think I missed a comment if somebody was talking about fusion. Oh, I did. Wait, what's going on here? Oh, I see. I went down too fast. Oh, Tia, thank you, Steve. Is that still happening? I want to buy more if that's the case. Short, scroll one. Ah! Okay, gut check time. Look at that. You bastards. Oh, and I missed it too. Oh, I'm so pissed. See, I said I wanted to short at one. Now, had I hit the short at 1,140, which 1,139 would have been close enough, of course. I expected not to break 1,140. Had I hit the short here at 1,139 and added 5 more, That would have brought me up to the point where right now I'd be pretty freaking happy. That's kind of annoying. Oh, here we go. Get another opportunity. What's going on now? Is everybody going up, though? I have to check my premise. Everybody's up. He broke his 407.5. This is bullish stuff going on. Is there any particular reason this is happening? Hang on, I'm going to check my news. Damn it, these conferences are expensive. This happened to me last week, too, and I wasn't paying attention. EMC. Denny's. Oh, Denny's is up 11%. No wonder the market's rallying. I see nothing. I see no reason for this. I like that. So if I see no reason for it, I'm inclined to go for it. All right. So, one. Oh, missed it. No, that's annoying. All right. Well, we got one. See, what I want to do is while we're under 140, I'm going to take a chance on 5, but I'm going to get out. I expect to average around 11935. If we go over 1140, I'm going to stop out because my premise is blown, and I would lose 5 times 5. 5 times 50 is going to be 250. So I'm going to risk 250 by adding 5 more because I'm going to get right the hell out if we go over 1140. So that was kind of annoying, but let's see what happens. See, now I'm going to be hoping that we get up to 11395 because that's where I'm going to want to add more. 393. And you see that when it comes up to a new level and it weakens, you see the number declining, you know it's weakening. See that? Weakening, probably going to go up. There you go. And already went up. Nope. Getting pushback. So let's sell another one here if we can. Got it. Okay. See that number? Weakening, going up. So it's going to go here next maybe. Nope. Somebody here is selling heavily then. All right. See, ran into the resistance. So that's how you can watch it. That's how you can watch it while it's going. Now, at this point here, I got a nice quick pullback. Nice quick pullback. I'm going to get out of it. I'm going to get out of the 2 new ones. I mean, one. Now I'm going to look to sell my other one. Okay. Because I don't really want to have. I didn't really want to have 7 shorts. I just added those to try to make a little extra on the way down. So what that did, even though it was a tiny little win, it still knocked a couple of $100 off my basis. That's all you want to do. You just want to keep knocking it off. The thing is, if you don't take your profits, what's the point of doing it? So in that particular case, starting at the 3233 here, where we just added those guys, coming back down to 36, that's how much is that? That's like $70. That's like $150 on 2 positions. All right, made that in 10 seconds. So if I can make 150 in and out real quick, I only have to do that 5 or 10 times, and I pay off the entire loss of the spread so far, and that raises my basis all the way up here. Now, I'm obviously not expecting that to happen so quickly, but you see, you can make that money back really fast by doing that. But I'm only taking little tiny chances. Why? Also because I'm in the hole. I want to get more in the hole. It just spiked up like crazy here to 140. Might do it again. So I want to make sure I have a position to add more. All right. So thanks, Steve, for telling me. Unfortunately, the way this chat box works, let's see if I can make it bigger. The way the chat box works, I only see people as I get to them. So if something happens now, I'm not going to see it for a minute. But thank you for telling me, or I never would have looked. Oh, here we go to 1139 again. All right, I'm trying to get off that, though. All right, thoughts on Gartman's premise on the price of oil on CNBC, called the U.S. for the glut. Yeah, I've been saying that forever, though. I've been saying I'm the one that called 80. I called 80 when it was out of fashion. When it was 110, I was calling 80. So we're here now. I'm satisfied now. I do think it can go all the way down to 70. I really don't see it going much below 70. Longer term, though, I've actually given this some thought. Longer term, if Lockheed Martin isn't bullshitting, okay, getting 1 fusion reactor isn't a big deal. But when you think of the change to this planet if they have commercial fusion working in 10 years, over the next 10 years, there will be 50 reactors, 100 reactors, and 10 years later, 20 years later, there'll be 1,000 reactors, 2,000 reactors. All of a sudden, the world will be getting 20, 25% of its energy from fusion. And if that works, and it works as advertised, we're talking like by the end of this century, getting almost all of our power from fusion, we'll essentially have free energy powering this planet. We'll totally change the world, totally. So, I mean, if you want a bullish long-term premise, that's about the most bullish long-term premise I can possibly think of. But, still. You know, obviously, well, look, it's the end of oil. You know, of course, that's going to be the end of oil. It's going to be the end of any kind of alternate fuel. It's the end of solar. If you have fusion, there's really no need to bother collecting energy from the sun if you can have the little fusion reactor that you put all your garbage in and it makes energy. The only thing, what's going to happen, though, the next thing you're going to run out of, though, is matter, right? Because the fusion reactors need matter to be powered. So eventually you need more matter, but they can always get that somehow. And it'll take a long time before we use all the matter on the planet, because E equals MC squared, of course, you know that. So you don't need a lot of matter to make a lot of energy. But that'll be the next thing we run out of. So until we run out of matter, we'll be good with fusion for quite a while. That will make stunning, gigantic, fundamental, global-reaching changes, possibly in our lifetime, for those of you who are going to plan to live 20 years or more. It'll be the biggest change in human history, basically. I don't know. It's too good. It's one of those things that's too good to be true, although I have, for many years, expected that's exactly the time frame I thought fusion was going to be operational. I kept telling people, like, 10 years ago, I'd say 20 years. You know, and 30 years ago. 30 years ago, I didn't know for sure, but 10 years ago, I started telling people 20 years would be fusion. And I was even though I was surprised, because I was kind of thinking I'd have to push back my time frame because things just didn't seem to be coming along right. All of a sudden, Lockheed made this announcement, and it's in line with what I thought 10 years ago, but it's not in line with what I thought last year, where I thought that we weren't making progress fast enough. It's an incredible thing. I can't even emphasize how incredible it will be if it does what they say it'll do, and that's the question, though. It's just such an incredible concept to imagine they've really solved a whole bunch of problems that were lingering. So we shall see. And on the other hand, though, computers, in 10 years, computers are going to be smarter than us, and that's a fact. That's not even a maybe thing. That's a fact. In 10 years, computers will be smarter than people, and they'll probably be able to fill in the gaps on anything that we can't solve anyway, as far as things like that go. I mean, there's another profound change that may not be a good change, but the computers are going to be, you'll be able to actually make computers that are smarter than Einstein, basically. And once they figure out how to program them to learn and understand and so on and so forth, you will have no limit to how many geniuses you have working on problems. You know, just any kind of problems that you get, you know, they'll be able to put brain power to work and solve it. And hopefully they won't figure out what, you know, hopefully at some point machines won't figure out, like, what are you guys doing here then? But other than that, it could be a paradise. And we'll see. If we live that long, of course, with all the terrorists and everything else that goes on. Let's see. So the interesting toss-up between the MIC and the energy complex. Yeah, I don't think there's no toss-up though, honestly. If fusion comes along, I mean, a stable fusion reaction powered by matter, you don't need any special matter to power it or anything like that. When you can just create and bottle and contain a fusion reaction, it gives off unlimited energy. And in theory, it shouldn't be bigger than somebody's house. You know, so something the size of a house can power an entire city, wherever you want to put it. You know, you just put it, it's going to be a thing, and they don't blow up, and they don't pollute, and they don't do anything bad. You know, they just you're just creating a matter transaction. And well, we don't think they blow up. We don't think they blow up. We don't think they pollute. We don't think that they endanger a city. But as far as we know, it should be fairly safe. But it just sounds too good to be true. That's my biggest problem at this point. Is like if something's bound to go wrong. It just everything can't just all of a sudden turn out great like that. My pessimist, I'm not even a pessimist. I'm usually an optimist. Just, you know, again, it's a timing issue. I have to get more facts to figure out if this really works. All right, Twitter, 10% down, Burr says. The puts can be sold for $1. Yeah. Here's my thing on a stock like that. First of all, I don't think that there's that much value in Twitter in the first place. Twitter, let me see what the number was. Don't forget, you know, this year's Twitter is last year's, I don't even know, I mean, not last year, you know, when I started my blog, my first blog, it was on Blogger. Blogger doesn't exist anymore, it's zero. Blogger, had they gone public, would have been a billion-plus company also, okay, because everybody was using it. It was very big, very popular, whatever. Before Blogger was MySpace. MySpace did go public and went bust, or, you know, Fox Forum, whatever the hell happened to them. These things come and go. These are fads. Google is a very rare sort of thing that sort of went past the fad stage, and but they spend a lot of money. They work really hard to keep themselves where they are. It's a constant treadmill to be on. Twitter is the current fad. They can be replaced by anything, and I watch the way my kids go from one thing to another. As my kids get older, year after year, the thing they used last year is inevitably something they wouldn't be caught dead using the next year. Like they're like, oh my God, that's what kids use. Like, you know, my daughter's 12, and she's like, anything an 11-year-old uses, she wouldn't touch. They just sort of flow from one thing to the next. Now we don't. We're adults. We tend to stick with stuff, but realistically, look, everybody's on Facebook now, right? But Facebook Facebook knocked off the previous guy. Twitter knocked off other things. Somebody's going to come along and knock those guys off too. So it's never a long-term investment to me. You talk about selling puts and ending up owning stock. The question is, you're talking about 10% down from here on those puts. If Twitter drops another 10%, do you want them? Do you really want them as a long-term part of your portfolio for net $39? Is that something you're dying to have? It sounds good. It sounds exciting, but the reality is, I don't know. I mean, if they've got such serious problems that they're down 10% now. If they drop another 10% and they can't recover, I don't want them. Then their problems are deeper than I was thinking. And even their projection of their go-forward projections, they're 115 times next year's earnings, which are now in question because they don't seem to be making the money they thought they were going to make. They could be at 200 times next year's earnings. Why would I want that? So, you know, so it's not something I would do because I don't really want them. And you should never sell a put on a stock you don't really want. Now, if you feel differently about Twitter, that's fine. You know, I mean, there's nothing wrong with it. But also logically, let's take a look at that. If you look at Twitter, see, and then we go back to this. See, because if you really want Twitter, if you really want to own it long term, then why take $1, okay, when you can sell the, you're talking about the 40 puts, right? You can sell the 2017 35 puts for $4. That's 4 times more money for a $5 lower strike. Okay, so your return, your risk is lower, your return is greater, your time frame is longer. It's you're doing a 1/4 sale, not even 1/4, 2 months. This is a 24-month sale, 26-month sale. So it's 10 times longer time frame, but you're getting 4 times more money at a 10% lower strike. I'm pretty sure your margins are comparable. Let's see. Margin here. If I go to sell this, where is it? So margin here is $3,000. Oh, I know it's beating on margin. So your margin is $3,000 here. If you sell the December 40s, January. Oh, where is December? I got to open that up. If you sell those December 40s, oh, look, you get $1.25. Sell it. Your margin is the same. So it's the same margin, less time. So it's all about the time. So if you're comfortable with it, first of all, I will say though, if you do want to do it and you do actually, and you can be comfortable with it, you can sell those, and then if they go bad, you can always roll to the lower ones. You can always roll down to these or something else. So I don't think it's a huge risk as long as at some point you have a price at which you're happy to own Twitter and make it a long-term investment. All right, if the market crashed tomorrow, would you still want CLF? Yes. I would. CLF is, they make iron ore pellets, which are used in steel production, and they are they're one of the only U.S. suppliers and one of the only North American suppliers. There's tons of these guys in Asia, but there's not too many of them in North America. That's the crux of their business. Is probably 60% of their business is North American iron ore pellet production. They've got a huge shipping advantage on everybody else. They've got a time to market advantage on everybody else. There's a lot of reasons they're a good, solid company, and also because America seems to be the healthiest economy in the world at the moment, so we're probably going to recover faster, which means that they'll have demand and things will take off. And also, we, by the way, are badly in need of infrastructure improvements. All right, so if we're badly in need of infrastructure improvements, another good reason. All right, Burr is now telling me that the Russell is moving up. I know that's old information, but let's take a look. At least it reminds me to look. Ah! All right. So now you see it's a reflex here. I know what I'm doing. I'm selling. I know I want to sell at this price. Selling again. Oh, you bastard. And it goes up again. Let's sell again. 8. Are we done? Please be done. Up. Now it's going down. Let's try to see if I can sneak one more. There we go. That was a head fake. Come on, where you go? Now it seems to be calming down. See if I can just sell one more. Oh. So what I do, I just sold 4 at around 130. Let's call it 398. Okay. So what happens if we get down to 395? Not 395. Let's say 394. If we get down to 394 and I can dump those, that's $200 right there. Forget the fact that it's losing money on the position at the moment. I've improved that loss by $200. Up. There we go. Now I must do that because that's my job. Didn't work. It hit 140. I know I expected to stop there. Therefore, I'm damn well going to sell my last one at 139 because that's the most I expect to get for another sale. Didn't work out, so I'm going to cancel it. But you see, it's a marginal sale. In other words, I sold 4 here at 8, gets back down here, and I buy them back at 4. Then I'm going to make $40 times 4, $160 on those. And it doesn't sound like much, but you make $160 over and over and over again, which is what I did last week. Remember last week we had the same situation. We had a big pop on Tuesday with the Russell, calmed down by Wednesday. Now we have the Fed thing, though. That's unfortunately, it's going to possibly go even higher at the moment. But I had a big I wanted a big position at a high price, and the way I got into a big position at a high price was by absorbing some losses on the way. I rode it all the way down, made some good money. I could have been braver actually and done a lot better, but I didn't want. I mean, I wasn't intending to take such a big position at the time, but I ended up in one. Let's see. Can't get that. Oh, there we go. Now I'm going to take it. It's a good sign that it's not filling me, because it means that nobody really wants them at that price. They're just trying to spike it, and they're probably trying to force stops over here. You know, force people to get out of their short positions. They don't want people getting more short positions. So now that last one filled. And I have to expect at this point they're going to really try hard to spike these things up. But he got weaker, and he got weaker, and he got weaker. They all stopped going up. So I got to think that he's probably going to stop going up too. So we'll see what happens. And if not, more expensive lessons. All right. Gartman call for $10 term volume. Okay, Mr. Fusion Bets the future. Would you put LMT? Yes, we had LMT actually. LMT is one we picked a while ago because of the war. As soon as we invaded, as soon as we started bombing the ISIS troops, we bombed people with Tomahawk missiles. That's like our primary bomb that we use. So those Tomahawk missiles are $1.4 million every time we fire one, and we'll fire like 50 to 100 on a given day. You know, we'll fire those things. That's like 50 million, 100 million. I'm sorry, 75 to 150 million dollars a day in Tomahawk missiles when we're having these little incursion actions. So that's when we went long on Lockheed Martin at the time. I forget when it was, a couple months ago. Let's see where they are now. I don't think they really went up as much as we thought they would, but the way we did it was a buy rate, so it didn't matter. Let's see. See, here we go. This is around where we came in. I think we came in around here in 160s, and we just, we played a conservative play at the time. It was like a buy rate where we were looking for like higher, anything higher than here would make us money. Now they're at the top of this channel. I would say if they come back down to 175-ish, if you can get back in at 175, I think I would like it for an entry. I certainly like them for a long-term play. And if they are they're telling you they're going to have fusion in 10 years, okay? If they were the only people who had fusion, they'd be $1 trillion company. They're not going to be the only people who have fusion, though. If they've solved the problem and there are 10 other guys solving the problem, I can't imagine that you could really patent. You can patent some very specific way you are solving fusion, but the concept isn't that, it's not something really patentable, although they patent all kinds of weird things these days, so who knows. But, yeah, I mean, over the course of 10 years, they're in the lead. If you buy into the technology, they're good to own, and they're also a good stock to own because we love to go to war and we love to bomb people from far away, and that's their specialty. There's nothing better than selling people a $1.5 million missile that they're going to shoot at somebody and blow up and come back to you a week later and say, I need another missile. It's a really great sales job, right? So I do like Lockheed Martin long term. You can do put sale here. I think I wouldn't know. Coming off of that jump, like if it's a 10% pop over here, I'd give him a chance to calm down a little bit. Hopefully we can get him around 175, sell puts around the 165 range, and then take him for a long-term ride. I'm not sure if we'll be using Facebook or Twitter 10 years from now, but we're going to be using Iron Ore still. Yep. Lockheed Martin Stealth desalination play too. Oh yeah, they're into that also. That's true. Yeah, desalination is also good business. Lockheed Martin's a good company. They do a lot of good stuff in addition to blowing people up. I thought they are rationing water in Sao Paulo. San Francisco's interesting. San Francisco finally figured out that it's not good that companies like Nestle are taking, not San Francisco, but California in general. California finally realized that companies like Nestle are sitting there taking their fresh water, bottling it, and shipping it out of the state. And they're adding to the drought in a drastic manner. They're shipping like, tens of millions of bottles of water out of state while people in California have to ration their water. That's just crazy. So California should start cracking down on that. That's going to be a very interesting thing for the bottled water industry because it's not only a ridiculous waste of water, like it takes 5 bottles of water to make a bottle of water. So it's not only a ridiculous waste of fresh water, but you're also you're moving water, unnaturally moving water from one place to another and causing problems. You're dislocating the system. It's like it doesn't seem like a big deal, but it really is a phenomenally big deal when you take a reservoir's worth of water and ship it out of the state. That's gone. It's out of the water system. Usually the water system recirculates in this general area. You're taking it and shipping it out all over the country and distributing it to places that don't need the water. Okay. Mick says, they said their Australia CapEx maintenance needs only $50 million over next year, and CLF doesn't sell it there. Yeah, okay, I'm not worried about CLF. I think they're in great shape. They did all the right things to cut themselves down and make themselves more profitable in a bad market. Chrissy says she wishes, yeah. Yes, I'm laughing, but I'm also going to be very pissed off if it stays that way. Tomahawks, right, we talked about that. Mick says we went long on RTN. On September 11th, non-official trade. Oh, we did RTN too. Okay, yeah. Would you go along the YN since it's a laggard? I'm not feeling the long here. Really not. I see. Now I'm pissed. I'm just not feeling that this is a sustainable rally. I think that we're up. Look, we're up because there's been a bunch of stimulus in Europe, and because everybody thinks the Fed is going to say something easy tomorrow. If the Fed doesn't say something easy tomorrow, this entire rally will reverse, a 50% reversal at least tomorrow. That's what I'm playing for, and I am going to stick this thing out. And if I get, believe me, if I get the money back, I'm going to get out like lightning. because I didn't really want to play it into the Fed. I was hoping for a sell-off sooner. But if we don't get the sell-off, I really don't think we're going to go that much higher, and I don't think the Fed is going to say anything that's going to sustain this rally. All right, so it'll be a nail biter, but I'll be, you know, if I take it into tomorrow, I will. I said this last week. We were in the exact same position last week, so I can't believe I let myself get into it again. But last week we had the same problem. We had the same big pop in the Russell, and it popped even higher overnight, but then it went all the way back down. That was just a week ago. We had the same situation. In fact, let's see if we can look at that. 1 hour. That's too long. 15 minutes. Yeah. Here we are Tuesday last week. I was giving the seminar, and when did we start? 1 o'clock, right? And while I was giving it, while I was talking to you guys, it did exactly what it did now. It went all the way from 1100 to 1110. It's actually, this is almost worse. But it went from 1100 to 1110. Then overnight, it took a little dip, popped to 1115, went back down. I think I was probably sleeping here, so I missed that part. But it popped back down, then it popped up again. Then it dropped and dropped and dropped and dropped and dropped and dropped and dropped all the way back down to below 1100 where it started, where we started shorting. All right, so this time I started shorting at 1130. I didn't start shorting here or here. We started shorting at 1130. And now it's at 1140, which is up 10. It might hit 1145 overnight. And I still expect the same exact thing. I expect that same sort of fall. See how the pattern's like so similar? See how that's going on? Even has this, little fall, then it picks up steam, heads back up. We got this, a little fall, picks up steam overnight. All right, and I just got to hope. Now, you have to realize that the Russell can get to 1200 again. So if I wanted to cover this, what I would do is buy a very aggressive TNA play. That would pay me well if it went like from 1140. Let's say it went from 1145 to 1160. I would buy a play, something in TNA that covered me for like a 4 times, 5 times return on that spread. So let's see. And also, yes, I could of course cover by buying some Dow longs. That's a really good suggestion. So I could pick up some Dow longs to cover, but I'm not going to because I feel very confident with the play, so I'm not going to do that. Let's see. And Burr says, are you going to leave 10 TF shorts open overnight, no stops? I probably will. Because I just don't imagine it doing more than 10 more points of damage, which is $10,000. I don't see that happening overnight, and I also think that we could just have a really, really nice thing. This is not again, it's a very aggressive strategy. This is the kind of strategy that you do when you have, when you play with $1 million or so, you can afford to make a strategy, or you can afford to play like this because it could pay off $50,000 if I get a good move down. That's all. And it's just a matter of putting my foot down and saying, this is something I believe is going to happen. It happened last week. I didn't take full advantage of it last week. This week I intended to take full advantage of it. But again, I don't really enjoy this. So if it comes back down and I can get back down to like 1135, I'll be back down to 2 positions. If I get back down to test this 1135, well, I'm going to kill this whole trade pretty much, except for a couple that I'll leave on. Then if that goes up to 145, I'll be happy to double down again. But this is, at this point, it's not in the position anymore where I would be happy to double down. TF can make into a spread with another index. Yeah, nah, it's fine. I think it's fine the way it is, though, because look at this run. This is a 40-point run. That's gigantic. Really not much of a pullback. 40-point run, little pullback here at 20. So what do we have now? Now we have another 20. I'm just looking for that same pullback. It didn't really pull back till 25. So if we get to 45, I'll be looking for the same pullback down to 8, and I'll be pretty happy. All right, we'll see what happens though. So where was I? Oh yeah. We were talking about Monday, and what we talked about was important. We did our long USO here. Oil's kind of slow to get going, but I think we put our foot down on being long here. We talked about Twitter yesterday, and I talked about the pricing, the value of Twitter, and talked about, and what did I say? We were talking about support. Oh, yeah. Where was it? There isn't really any support until it hits 42, and below that, we've already seen how fast it can drop in April. So what's it doing today? It's doing exactly that, right? It's down to 44. It held the 42 line, which is the support we expected. Let me see if I can find Twitter. We have today's chart on it. Yahoo. Yahoo Finance, by the way, has done a really fantastic job. They've done a really, their new charts are fantastic. Take a look at that. I am so happy with the way they've revamped their charts. If it'll pull it up for me. Here we go. Ugh. Okay, indicator. That's not what I want. How do I make that be a candle? Ah, candle, there we go. So where were we? 5 days. All right, so you see that support line there? That's the 5% rule. We knew there was going to be support at 42. That's where you play it for a bounce. Now, what's the bounce? From 50 to 42 is $8. That means your bounce is how much? $1.60. Where is it now? All right, $8, 20% bounce, $1.60, $43.60. Boom, that's a weak bounce. That's the exact definition of what a weak bounce is. All right, so that's where Twitter is at the moment, and it hit its support line here. Gets a weak bounce off that. It needs to get another $1.60, so that's $45.20. So $45.20 is a strong bounce. That's when you can call it recovering, but not until you get up here. At the moment, this is a weak bounce. It's probably indicating it's going to go further down. If it fails to hold 42, there's really horrible support for this thing all the way down. All right, and that's what we were talking about yesterday. That below the 48 line, there isn't support until 42. And below that, we've already seen how fast it can drop. So, and what happened in April? In April, it failed its support at 42. This is the 5% lines right here. And then, boom, nothing at all until it hits 30. So that can get very, very ugly for Twitter very, very fast. And Buffalo Wild Wings had a good day. They went up nicely. Very good move on those guys. Let's see. And we had another important conversation I wanted to talk about. Boy, we have a lot of stuff we cover in chat, don't we? All right, I apologize. I guess it wasn't there. All right. And then we have today in chat. We're talking about something in the morning that was kind of important. These are the levels we were looking at this morning. And we were trying to play short, but none of these crosses held. And that's the thing. When your premise doesn't hold, you can't keep playing it. See, at 1/120, we took a shot at short. That was back at 9/12. But once those lines break on you, you got to get out of the trade. You know, we did, and even though I got out of it, I got back in at 1:30, and unfortunately I got distracted, so then I got screwed. But if that happens, you just got to really think about it. You got to step back and think about where you're going to be. We did the TZA spread earlier. We looked at TF back here. It was well, that's interesting. This chart doesn't adjust. Thought it would. Oh no, I took a picture of that. That's what. And we were talking about that earlier on these Russell ones. I guess that was what I wanted to talk about with you guys. All right, so let's get back to answering some questions. I got to get this thing finished up. Hope is not a strategy, Nick. That's an excellent. Or whoever said that. Chrissy said that. Hope is not a strategy. It isn't. You can't hope, and you can't sit there and say, "I hope this works out." That's a terrible way to look at things. All right, so when something goes against you, you've got to be well prepared. See, that's 29.40 now. You have to be well prepared to lose the money. You have to say, what will I do if it does this? What will I do if I'm down $7,000, $10,000? And if you aren't comfortable with what you're going to do at those points, don't trade it. Get out. But you shouldn't be making it. You shouldn't even be in that position where you're worried about it. You know, you have to before you enter the first piece of the trade. You have to say, what's going to happen if I do this and do that and do this and do that? And every time you do it, you have to say, what if I'm totally wrong and what's my worst case? What am I going to do then? And if you're not comfortable with it, what am I going to do then you shouldn't be making that next step. And Mick wants CNBC to go butts. That's interesting. I see that you said that. Versus, why not close the unlimited loss short and put a long inverse ETF that will limit risk for purchase puts on the future, unlimited loss positions while sleeping scare me? Yeah, they scare me too, frankly. I don't like it either. So I don't usually do it. It's uncomfortable, but if you get forced into it, sometimes you do get forced into it, and you can have an unlimited loss. But, you know, realistically, it's not unlimited. And like I said, what I'll probably do, though, is buy a TNA. And let's talk about that because that's important. So realistically, it's not going to go up. The rest is not going to go up more than 10%. 10% is going to be another 15 points. Okay, 15 points with 10 positions open is $15,000. So if you go to TNA and you think, what would happen if the Russell went up 10%? Well, then TNA would go up 30% if the Russell went up 10%. 30% on the Russell on TNA is, what is that, 70, so it's about 20 bucks move on here. So I could pick up the 70s, November, for 330, 345, 330, so it's called 340. And the 75s are 140. All right, so that spread is $2. So I could pick up that spread, and the delta is 52 here, and on the 75s, the delta is 28. So your net delta is 24. So if I take that spread for $2, the net delta is 24. If the Russell drops 10%, I'm going to lose pretty much $2. Okay, so I'm going to lose my spread if the Russell drops 10%. If the Russell goes up 10%, not even 10%, if the Russell goes up 5%, because if it goes up 5%, this guy goes up 15%. If he goes up 15%, that's 7 is $10. That's 80. So what did I say? 75? No, I'm sorry. I started low. So it doesn't even. The Russell barely has to go up at all, and I'm going to make 150%. All right. So there's my risk reward there. Since I don't need that though, since that's obviously over covering, what I can do is pick up these 75s for $1.50. Sell these 80s for 40 cents. So now I'm spending $1.10, and now I've got almost a 400% upside if the Russell goes up. So now 400%. How much am I going to lose on the other side? I'm going to lose $15,000 on a big move against me. So if I put down $2,000 on this spread, on the 75-80 spread, that $2,000 will return $10,000 if the Russell pops up on me. Okay, if the Russell goes down instead and I lose my $2,000 on my spread, obviously I'm going to make $10,000, $15,000 on the other one, on the futures. So I can mitigate half my losses going up against me. Okay, for $2,000, I mitigate half my losses. And if I lose money on the futures, the only way I'm going to lose money, I'm talking about between now and the Fed. If I'm going to lose money on that position, then it's going to be only because I made money on my futures. So that's the way you hedge something like that. But the problem is, now here's the problem with that play though. You have to realize also though, what if we get a dip into the close and I cancel out of the position? Or what if I get a dip after the close and I cancel out of the position? Well, if I cancel out of the position even, then I'm sitting there with my stupid short position open that I didn't want to have overnight. So then I have just a short, I'm not even protecting anything. So you have to think of that also when you're doing it. So on the whole, I'm not terribly inclined to cover it at the moment because I really believe it's going to pull back. But probably if push comes to shove, if we're still up into the close, if we're closing near the highs, then I am going to want to take that cover. And I think that's about the right amount, about $2,000. That'll pay me back $10,000 if it all hits the fan. So at least I mitigate half my losses. All right. When a stock hits its weak bounce, when do you decide to go short, and how long do you wait and see if it hits its strong bounce? Generally, you want to see symmetry. So, in other words, if a stock is weak bouncing, it depends on if it's symmetrical to the drop. Let's see how we could illustrate that. Let's go back to Yahoo. They really good for that stuff. I mean, these charts now, the reason Yahoo's great, look how great this is. 3 months, 6 months, year to date, 1 year. You can move your time frame on the year. Well, you should be able to. That's weird. Oh, because it's Twitter. Okay, it depends on the stock. That's BTU. So when you have your year, oh no. I don't know why. Maybe there's some Java problem or something on this. But you are supposed to be able to slide the stock and see the rest of the chart. It's really fantastic. I mean, you can slide your time frames. I love it. Even when you have comparisons, we do this in charts, and you can show the comparison sliding over time. I wish I could do it, but I can't on this computer for whatever reason. Probably all these idiotic things for my kids load up. Nope, it's not going to work. Anyhow, so where were we? The question was, weak bounce, when do you decide to go short? Right. So let's go with TNA, for example, and we'll do a month. Nope, it's too short. 3 months. Okay. So here's the thing. If it's a time frame, so you want to see a V, and the less you see a V on the bounce, as the time frame extends, that's another sign of weakness. So it's not just the amount, but it's the time it takes it to do it. You think of it like it's physics, like it's a ball bouncing. If you throw a ball down and it goes right back up, then it's a Super Bowl, right? And it's going bouncing. And what you're going to see is an almost completion of the pattern. Like if you drop a ball, if you drop a ball from here to here, a Super Bowl will bounce all the way back to here, right? Like 80% bounce. A regular ball, like a basketball, will drop about halfway, and then the next bounce will be another half, and the next bounce. So it's more like a basketball kind of bounce you look for. A basketball bounce is weak, and a basketball bounce means you're going to get a bounce. It's going to be less than a full bounce. It goes back, and then the next bounce is even lower than that, and the next bounce will be lower, and it dribbles out. That's weakness, right? If it's strong, you're going to see the sign of strength. Here is a strong recovery, right? So let's see what this was. This was from, I'd probably call this like from 75. It's hard with the ultras to say. Let's do IWM instead, because you can't really tell with an ultra because they do wacky stuff. So here's the IWM. So clearly, well, I'm sorry, not clearly. Here, let me go back for you. I'll show you why. You take a long-term view to start, and you say, okay, where did we come from? We came from 80, had good support along the 80 line, made a break, and that means 120, 50% move makes sense for the top of a big move. So that's where we came from. And we know that because the Russell was 1200. I wanted to just show you exactly what we're talking about. So we're coming from the 1200 line. We're not coming from here. You can't confuse yourself. When you're taking that, when you're looking at 1 month, you can confuse yourself by looking at certain time frames, like we were looking at 3 months. This isn't right. And I'm looking at this thing, it's a weird line. That doesn't look like you can say anything about that line for sure. And the reason you can't, though, is because that's already a pullback line from 1200, 120. So we fell from 120 to 105. That's a 15-point drop. All right, so we already know the answer. So the 15-point drop, you've got 3 is, you're going to have a 20% retrace, so 3 points. I wish this thing worked right. It doesn't, though. It's just something's not working. I'm not getting my lines and such that I should be getting. But you get a 3-point move to 108, right? And there you can see it right here, a little consolidation along that line. So 108 is a weak bounce, and we hit the weak bounce very quickly. So it shot up to the weak bounce, a little bit of a consolidation right here, stopped at 108, back down, but held around 108, came back over 108. These are good signs. This is all bullish. It means you're consolidating at the weak bounce trying to go up. We do pop up. We pop up exactly to the strong bounce at 111, right? The next 20% recovery is the strong bounce. That's 111. But we did it in a better time frame. we're actually in a time frame that's better than the dropping time frame. We're recovering faster than we fell. That's bullish. And if we're consolidating, so like I said, if we're consolidating up here, we're probably in a bullish move. But that's a pure TA thing. Now you have to go back to saying, now why is this happening? Why is this happening? Because we went back to the Fed happy talk. This recovery is an anticipation of an action that is supposed to occur tomorrow. This is not a natural reaction. This is an unnatural reaction. You can see what happened here. See how the volume, heavy volume going down, right? Here, we had a big pop on, this is good volume. We had a big pop on good volume, but right away the volume dies off, really dies off fast. So we're going up, but we're running out of, people aren't really buying into this. Just slow, it's just being jammed up. Being jammed up into the Fed, and there's good reasons for this. The banks want to do this because the banks want to jam the market up into the Fed because there's two reasons. First of all, they want to be in a position to buy, like they've already been buying. They bought at the bottom. They want to be in a position to buy if the Fed does something nice. If the Fed doesn't do something nice, though, the banks are going to mercilessly dump what they bought because they'll average out. You know, they're going to take the Fed. If the Fed's good, the market will pop and the banks will make tons of money. If the Fed's bad, the banks were buying here. It's all the retail suckers that are buying up here. The banks will dump like crazy. They'll average out at better than where they bought, and they'll be gone. But also they're going to punish the Fed for not giving them more free money. And they're going to knock that market right down. That's going to teach them a lesson and say, you damn well better support this market or we're going to kill you. That's all it is. It's just strong arm tactics. So anyway, so I think that this is unnaturally up. It's up. It's very, very strong. And if this were a company, I'd be like, yeah, great. And yeah, you can say there's earnings and the company's doing okay with their earnings, but they're not doing that fantastically. We just looked at that this morning as far as the revenues versus the earnings. And the U.S. companies, of course, in the Russell are doing better than all the companies that have overseas business. They are stronger because the American economy is doing better. There's some good reasons for the Russell to go back up. But as we get up to a almost 50% recovery at 1115, I'm sorry, not 115. You have 120 to 105, you're 15, so 7.5 points over that is 112.50. As you get up near 112.50, you're going to hit some serious resistance at this 50% line. It's right about here. You're going to hit serious, see over here too, 112.50, 112.50, all this is 112.50. You're going to hit serious resistance over there. So I don't think we're going to really get past there without a pullback. And the pullback from 105 to 112.50, 7.5. So your pullback's going to be 1.5 back to 111. So in other words, I don't think it's going to get worse than here because I think even if it goes up, we're going to get a pullback to here, and then a stronger pullback will take you back to another down 109.50-ish down here. So I think if 110 holds, great, but that's going to be great for me because I'm short above that line. And if it holds 111 on the pullback, I'll know that I should get out also. You know, but you know these trades have many days to play out, so I'm not too worried about it. Why would you buy TNA now that TF has moved so much? I thought you're supposed to think in reverse. No, I'm buying the TNAs just to cover the open short futures position. That's why. It's got nothing to do with what I don't. It's not because I think TNA's. Whoa. Wrong thing. It's not because I think TNA, it's not because I'm suddenly bullish on the Russell, it's just because I want to protect myself from further damage on this stuff. All right, that's why. It's got nothing, it's not because I'm trying to play it long or anything like that. To be long on TF, you could sell the TF to 7. No, yeah, but yeah, you could. I could sell other futures and blah, blah, blah and do all this stuff. I'm not looking to do that, though. I'm just looking to make a simple play. I'm not, you know, I could engineer all sorts of things, but let's keep it normal and talk about how you can do different ways you can cover it. Chrissy says, what I'm confused about is to get your strong bounce line, then you should automatically assume it will go higher. What? No, the strong bounce line is a simple calculation. You went down from 12 to 105. That's 15 points. 20% of that drop is a bounce. So 20% of 15 is 3. So 108 is a weak bounce, and 111 is a strong bounce. That's a fact. I knew that here. As soon as I know I'm consolidating on 105, as soon as I see that we're consolidating back on this line, then I say, well, if we're going higher, then our first goal is 108. Our second goal is 111. Okay, breaking over 111 is a sign of strength. Hitting 111 is not necessarily a sign of strength, but the fact that we did it so quickly is a sign of strength. So it's like there's factors that you have to look at. There's a factor that we came up fast, sign of strength. Hitting 111 is a sign of strength, but it has to get over 111 or it's not a sign of strength. Then it just means that you had a strong bounce. Let's see. And Chrissy says, what I'm confused about, oh, I'm sorry, we just read that with a TA perspective. Let's see. If you get to your snow, you have to go over your strong bounce line to assume it'll go higher. So yeah, it is what you say is a bear flag because it's the same kind. It's conceptually the same thing. It's what you assume. It's what you say is a bear flag, which is basically this pattern, is the failure at the strong bounce line. That's how the 5% rule explains it. Saying, well, here's your strong bounce line. If you fail to get over your strong bounce line, you're almost certainly going to retrace. And the longer you fail, the more likely it is you're going to retrace. That's what I'm playing for now. I started shorting at about the strong bounce line. We're over the strong, well, we're a little bit over. I shorted a little earlier than I should have probably. But I shorted here. It went up to here. And now we're drifting over here, but we're not breaking the line. So I'm not yet ready to sort of like panic out of the thing. I mean, actually, it's a 113 is over. It's a 113.73 now. And that's a 2.5% for the day. Damn. Oh, you bastard. Okay. I was going to say, I said, well, how did that suddenly happen? It did suddenly happen. Look at that. So while we're chatting, it's going on. So, as far as I know, it could go up to 1145. And like I said, I'm going to be down $10,000, and I got to accept that fact. And I'm going to have to just see what happens. So at that point, like I said, at the end of the day now, I would cover and take that TNA because I would like to not lose $8,000 if I can avoid it. All right, I'm happy at this point. I'll be thrilled to lose $2,000 on the TNA spread in exchange for getting this $5,000 back. Right, that's a good trade-off. But we'll see what holds up. But again, I still think that this is all just a big attempt to spike everyone out. You see how these are going up like this? Everyone's getting pushed up into the close. Everything's supposed to look great into the Fed. And then God forbid the Fed says anything wrong tomorrow. This market's going to tank so fast your head's going to spin. All right. So let's see. Let's look at the bigger picture on the chart. Wow, 2.25%, 1.5. It's so far ahead at 2.25%. It's just hard to even imagine. The Nikkei here, going along the Nikkei is a good way. If you think this thing's going to last, the Nikkei should be higher at 15.4. So that's when you can go long on, which pays well. It pays $5 per contract on the way up. The dollar is down, but not so much today. Oil made it up to 81.34. Gold 12.29. Copper has a great day, 3.09. That'll be a good short at 3.10, by the way. Silver, and again, when I say good short, it's a good short at 3.10. At 3.10.04 or 02, you get out. But at 3.10, it's worth testing. It's very likely, since it's had such a big run from like 3.025 to 3.10, you're almost certainly going to get a bit of pullback off of that line. Natural gas is waking up. Gasoline staying sort of flat. The VIX, look at the VIX, it's all the way back down to 15 now. Popped out 1843 there. Oh, CNBC, you bastards. See, that sucks. I would have gotten out. I would have gotten out if I'd heard that. I would have gotten out of those shorts. But there you go. See, it's not just that they're saying the Fed is going to pause. They're saying the Fed is suddenly going to turn around 180 degrees and start talking about easing again. And talk about another round of easing now that they finally brought this round to a halt. I think that's completely unrealistic. But what can you do, right? And we're not going to complain because the point is, if you look at the portfolios, wait for the long term. The long-term portfolio already, it's probably doing better now, but it's already at 20% this morning. Look at that, 20.9%. See, and that's another reason because you got a profit of $104,000 on the long-term portfolio. And that's another thing. Don't forget, there's another reason on TF because if I'm long, if I'm generally bullish in my long-term positions, using TF as a hedge in case the market tanks is a way to generate cash on the way down, put it in. On the way up, well, this portfolio made $10,000 today. You know, so it's just it's just another form of hedging when you're playing the futures. You shouldn't be betting the same way that you've got most of your bets. So we have the long-term portfolio at 20.9%. That's a huge recovery. We looked at the income portfolio already. Very slow. There we go. Look, see that's up 2 more percent since we were talking about it before. And the short-term portfolio, meanwhile, another way that we're hedging, right, with the short positions either covering either the long-term portfolio or the income portfolio. The short-term portfolio has fallen from 100% this morning to 91%. So in one day, it's lost like $8,500. And it's the same thing, though. I laugh about that because the long-term portfolio made more than $8,500. And that's the point of these things. When you have hedges, you want your hedges to lose money. You know, so I don't mind losing $5,000 on a Russell hedge when I'm making $25,000 on my long position. I wouldn't be doing the Russell hedge in any kind of substantial way, except that I want to lock in these gains. As we're going up, every time I add another short position, I'm locking in the gains on my long-term portfolio. Because if it drops now, I may go back down, you know, I may go back down 10,000 on the long-term portfolio, but I got 10,000 cash off the futures I can now put into more long-term positions. So it's all a balancing act, you know. So it's a constant balancing act. But you know, the way you balance it, though, is to take advantage of the other side of the trade. So when you're having a good run up, you got to say, well, what could I short? What could I short? What could I short? When you're having a good run down, you got to say, well, what can I pick up long now? You got to take those profits and use them for something, and you got to use them for something you're willing to stick with long term. Even though you might get out short term if it works out, you still want to have something you might want to stick with long term. All right, so that's good. I think we're out of time at the moment. And tune in next week. Oh, wow. Let's see. Wait, next week I'll be in Vegas. Okay, well, live in Las Vegas next week, I guess. I'm going to try to do this. I've never done it on the laptop before. I've never tried it. I'm not sure what's going to happen. But we're going to give it a shot next week in Las Vegas, okay? So tune in next week and we'll do another show. And I hope you guys are coming to Las Vegas also so we can see you all live. How can I email you if I'm only a partial member? If you're only a partial member, you can't email me, I guess. You can send an email to Greg at greg@philstockworld.com. He's our admin guy. And if you want to, like, especially if it's about the seminar or anything else, but there's a sign-up page for the webinar. If you look on today's post, you'll see the sign-up link for the webinar, for the seminar in Las Vegas. All right, and by the way, I got to tell you guys, if you didn't get the rooms yet, those Nobu hotel rooms, also linked on the thing, are the most fantastic, elegant, gorgeous rooms you will ever stay in. It's just an incredible place. Same thing, Chrissy. Just go through Greg. So I highly, highly recommend it. It's just a great trip. Isn't Vegas on Veterans Day? Yes, it is. That's why we do it that weekend. It's kind of one of those days that you can sort of kind of take off. But the Monday that we do the seminar, we do live trading all day long. So we're looking at all the stocks live. We're looking at everything live. We're talking about the charts while it's happening. It's really a great learning experience. And at night on Sunday, we look at the futures when the futures open up. And in the morning on Monday, we play the futures. And during the day, we talk about the futures just like we're doing like right now, except we're constantly like tracking the whole day, looking at the news, doing everything that we're supposed to do to make our decisions. It's really fantastic. And last year we had some really very, very successful plays. Not only that, though, but we identify a ton of stuff. In fact, our buy list last year came off, we started to kick it off at the seminar. That's how we get these things going. So it's the 11th? I think it's the 9th and 10th. I don't know what day Veterans Day is. It's that weekend, though. The 9th, Sunday, it's the first day of the webinar. We have a brunch, and we usually it's at 10 o'clock because the night before we have a poker tournament. So we start Sunday at the night before we have dinner at Nobu Hotel at Nobu, and then we have a poker tournament. Then Sunday about 10 o'clock we usually start the session. We do that until about 4 o'clock, so 6 hours on Sunday, and we talk about all sorts of things. And by right about 3 o'clock is when the futures open, and 6 o'clock in the East Coast. Monday at 6 a.m. because that's, it's to be open at 9:30. So I'm there at 6. You guys come whenever you want, but I'm there at 6. And we're doing live trading all day long until the end of the market session. And the pool party is every day. I mean, that place, Caesar's Palace has the most, Nobu Hotel is inside Caesar's Palace. It's like a separate little hotel inside of Caesar's. They have the best pool I have ever swam in. It's like an incredible thing. I love that place. Anyway, so I'm off to Vegas. You guys have a wonderful time, and I'll speak to you next week. And hopefully I'll see some of you guys out there. All right? Thanks.